Guys, again here. Thanks for tuning in. This will be seminar three worked solutions. And again, I do not claim credits for any of these questions that I'm going through. They are all set by NTU. So without further ado, let's go to the first question. And in the first question, we are supposed to do an allocation to the revenue computation. So, taking a look at the question, we first get that the company SL receives some form of revenue from their customer, and they have to deliver 50 units of Supercoin on some future date. So this would be unearned revenue, as discussed from last week. And there is a contract that states that the ownership passes to customer A when SL delivers to a roller, a third party carrier. So this will be when the ownership of the item will be transferred fully to A, and SL will be absolved of any liabilities for the product. Right? And we are also told that SL provides a replacement shipment of Supercoin at no additional cost if the product is lost in transit. So this is some form of insurance, right? And the significance of this ownership would pertain to the revenue or commission, right? So moving on, the standalone price of one Supercoin is 1.4 per unit. And the standalone price for the replacement insurance, yeah, so over here they say it's an insurance, would be 70 per unit. And there's 50 units to be delivered and 50 units for insurance, right? And the delivery was made. So roller picked up on 31st. So this is when you recognize the revenue. And delivery was made to customer A on the 1st of August. So this is when the insurance service can be recognized. So we're told to ignore any cost of goods sold. Um, we do not need to match any revenue to the COGS in this question. And let's start to solve the required question. So the first question asks, what is the performance obligation and the remove performance obligation? So for part one, which I will just solve here, and we are told that there's two things in this contract, the super coin and the replacement shipment. So essentially there will be two, the super coin of 50 units and two, the insurance for 50 units. That if they are lost in transit, the SL would have to provide this replacement. And these are the two performance obligation under this contract. So going on to question two, determine the allocation of the transaction price to the performance obligation identified in the contract. So moving on to part two, we know that the revenue earned is equal to the 70,000 stated at the top. Okay, and then we have the standalone prices. So let's compute the standalone price. So for the performance obligation, we have two, right? So the first one is Supercoin. Then the second is the insurance service. Insurance. So we want to find out for the Supercoin, what is the selling price, the standalone selling price, not the amount that's sell received. So the standalone price is 1.4K for Supercoin and 70 for replacement insurance. So what we would have to do is we would have 1.4 times 50 units, and we have 70 times 50. And that would give us 70K. This will be 3.5. Okay. Okay, and we can compute the total here. So the total will be 73.5 thousand. Okay, and these are the standalone prices, right? And now what we need to do is we need to perform the allocation to the 70K over here, right? So to allocate the amount for the super coin, it would be 70 over, so this value here, over the total 73 600, right? So, and that would give us 95%. And similarly, we can do this for the insurance. Oh, 73.5. And we get 5%, right? The remainder. So this is the allocation. And if we allocate it to the 70,000, we would get the value of 66.667. Yeah, I just write it as this, and we will have 3, 3, 3, 3. So I will not be able to. Um, and we know that the total of these two added together would give us the 7,000. So this will be the allocation with regards to the performance obligation. So in general, what we would have is, and if you really want to express this in math, you will just your performance obligation. So your obligation at you at standalone price over the sum of the obligation alone price. So in this example, say for Supercoin, the numerator will be 70, and the sum of all obligations standalone price will be 73.5. And this is how you will compute that percentage of allocation. So your percentage allocation, and yeah, you want 100%. So that would be for number two. I hope that's clear. And for number three, under the SFIS 15, when and how much should SL recognize revenue from the contract with customer A? Okay, so this is a revenue recognition question. And there are 2 dates given, 31st July and 1st of August. So I think I already alluded the answer. The 31st of July would be to recognize the revenue for the Supercoin, and the 1st of August for the insurance service. Okay. And we need to prepare the journal entries. So maybe I will do it here. Okay. So for the 31st of July, we have the revenue from Supercoin. And then for the 1st of August, we have the revenue insurance service. Okay. To prepare the journal entries, what we need to do first is recall that on the 1st of July here, there is a payment of cash to SL, resulting in an unearned revenue. So we have to start with the journal entry for that. So let's begin. So for the 1st of July, we have cash and we have unearned revenue. So given the debit and the credit here, so if we credit 70K to cash, then we need to match it on the other side with the unearned revenue. Okay. And moving on to the next date. So on the 31st of July, recall on 31st of July, the Supercoin was delivered to Roller. So now what you need to do is you need to recognize the revenue for the Supercoin, right? And when you want to recognize the revenue for the super coin, what we would do is we would convert the unearned revenue to the revenue recognized. So unearned revenue to the revenue for super coin. I hope these abbreviations are uh, clear. So to decrease unearned revenue, you would have to debit the amount, right? Because it's a liability. So we have to debit by the allocated price of this 66, 667 in total. So 6, 7, and we perform the same entry on the other side. And again, the entries matches so that there's no, yeah, it balances on both sides. And on the 1st of August, so recall over here that COGS is not, right? Meaning we do not need to match this revenue with any cost of sales. So which is why this entry would be very simplified. And on the 1st of August, we have the remaining unearned revenue here. And we have the revenue from the insurance, the remaining three. Yeah. So this will be the general entries. And you will notice that left side equal to right side. So we can be sure that we didn't miss out anything. Okay, and that would be for question one, which would be the recognition of revenue and the allocation of revenue. So moving on to the next question, Michael Scott Paper Company. So moving on to question two. In question two, we are told to do the measurement and reporting of AR, and we have to produce an aging table here. So I would use AR to denote account receivable in this question. And we are given the AR for different time periods down here. And we are also given the average loss rate down here. And the last item that we are given would be the allowance for impairment of AR holding a debit balance. All right. So with all these numbers, we are able to solve part one first. And part one is to determine the impairment loss and the journal entry for the impairment loss. So to start off, it would help to draw the table for the aging AR. So we have the AR here, uh, and I will not write out the full you know, aging AR statement. I'll just write out the values in the interest of time. And we have the estimated percentage loss, right? So that would be 2%, 12, and 30. So with the AR and the estimated percentage loss, we are able to calculate the estimated uncollectible AR because this percentage here is the estimated bad debt. So our dollar value loss, the estimated dollar value loss, in fact, would be just the multiplication of 80K with 2%, right? And you should get these values here. And if we find the total of these entries, we would get 8.2 thousand. Okay, so we have the estimated dollar loss now. And we now have to find out we have to write out the journal entry for the uh, impairment loss, right? So this value computed here is the allowance for impairment for AR. Okay. And the allowance for impairment for AR is a contra asset. Meaning, if you want to decrease, you would have to debit, and if you want to increase, you would have to credit. And it contrasts the AR. So we have AR, we have the allowance from the AR, and if we look at net AR, so this is how this allowance would work. And what we do is now that we know the how this allowance will work, we would expect that the allowance for impairment of AR to usually hold a credit balance, meaning this 8.2K calculated is to be a credit balance. Now we are told that the allowance right now would be 1.5 debit balance. So we are told that now it's 1.5 debit, and we want to transform this into a credit balance. So to do that, what we first need to do is we need to zero out the um, the account. To do that, we credit 1.5. To bring it up to 8.2, we will credit an 8.2. And the sum of this will give us 9.7K. And this is the total credit amount that we need to enter into the allowance for impairment for AR. So to do the journal entry, we know that we have to do in for AR, and then we have the allowance for the impairment for AR. We have debit, we have credit. So this is 9.7, and then we have 9.7 here. And yeah, the table balances out really nicely. So this is the end for one. Right? Now for part two, we need to determine the carrying amount of AR to be reported on the balance sheet. So two, I think here it's very clear. This is the equation that we need to use. We are given the total AR of 126. We know the allowance for the impairment for AR to be 9.7. Okay. Uh, so right now we would have to calculate the final value, right? And the net AR is equal to 116,300. Okay, so the last part of three, on the 31st of January 2021, an AR for 1.8 from the prior year was determined to be uncollectible and written off. So to do a write-off, what we need to do is we would decrease the allowance for impairment, and we would also decrease the AR, right? And we know that this journal entry does not impact the net income in any way because it is already factored for. So to perform this, we have the allowance, the impairment for AR, and then we have AR. So recall, if you cannot collect the amount from AR and you are writing off this value, we are actually decreasing the AR. So it will be a credit balance. And this would mean that the allowance would be a debit balance. So if we think about it this way, because allowance for impairment of AR is a contra asset, to decrease a contra asset, we would debit. So, which is why this is a debit entry. And with this, we have solved the three questions for the three parts to the question two. I hope that this walkthrough was helpful. And thank you once again.